Sec. Hi, everyone. My name is Lena Castanos, and I will be moderating today's webinar. I will begin by introducing the Capital Pathways program. Then I will introduce myself and give the word to our guest speaker, Kara Glasheen, Business Advisor at the Capital Regions SBDC, who will introduce herself and take us through a presentation on organizing your business finances. Feel free to ask any questions throughout the Q&A function throughout the presentation. We will be responding to them as we go. The questions that we cannot respond to in this webinar, we are happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording and slides of this webinar afterwards. So, what is Capital Pathways? Capital Pathways is a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We can start with the program overview, then we will go through the program eligibility and finalize with its services. Capital Pathways is a no-cost specialized SBDC program that helps small businesses build the systems and habits needed to become capital ready. Why does it matter? Being capital ready matters because those less prepared select out or fail applications. Early failures correlate to lack of adequate capital. Higher cost alternatives don't build long-term capacity. Only half of requested amounts reach small businesses. And to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, just about 20 to 30% of those who apply for loans actually get their loans approved. Capital Pathways creates a path to financial and legal readiness. Our program offers immersive hands-on group experience paired with one-on-one support. Who is eligible? Very small businesses and nonprofits at any stage facing challenges accessing traditional financing. The services that we provide include a guided self-assessment, legal structure validation, financial skills and tools, and loan application readiness. We start with a self-assessment that pinpoints your business key gaps so we can connect you with the right tailored resources either through our Capital Pathways program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through more basic legal questions, and we partner with a law firm which can help you for more complex topics related to business registrations, trademarks, and contracts and agreement reviews. We also offer financial webinars on topics including financial basics, like today's financial statement preparation and analysis, and QuickBooks training. Another one of our offerings includes one-on-one individualized and tailored support on business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, loan readiness, and lender prep. Finally, our loan application readiness services include both webinars and one-on-one individualized support. The webinars are on topics such as what lenders look for in loan applications, interactive mock loan interviews and sample application analyses, and SBA loan options. We also have a partnership with a lender that provides one-on-one support for those looking for capital. If you're interested in getting started, you can reach out through our website at virginiasbdc.com /program/capital-pathways. Or you can reach out to me directly at my email at lcastano@gmu.edu. I will include these links in the chat and as well as my email. Now over to introductions. As mentioned before, my name is Lena Castanos and I am today's moderator. I have a professional background in economic development, small business support, and access to finance projects domestically and internationally. I am currently both a program lead and a business advisor in the Capital Pathways program. Today's session will consist of a 90-minute presentation Again, feel free to ask any questions throughout the presentation via the Q&A function. We will be responding to them as we go. We will also leave some room for questions in the end. The questions that we cannot respond to in this webinar, we're happy to address through our no-cost one-on-one services or connect you to resources that can help. We will share a recording and slides of this webinar afterwards. Now, I will give it over to Kara to introduce herself, tell us a bit about her background, and start her presentation.
All right, all set up. Thank you, Lena, for the introduction and for sharing about Capital Pathways. I can't say enough good things about the program she runs across the state. It is a unique offering that is a little bit different from our other SBDCs. So if you already work with an SBDC, you can work with Capital Pathways and you can work back and forth and find the right advisor for you. So we are ready to go. Today's webinar is on financial basics. Uh, Again, this is to really aimed at supporting business owners who have a lot of the structural organizational pieces of their business put together, whether you're new or have been operating for several years. Let's get into it. So I wanted to start with an example. So let's meet Sarah, a successful Richmond cleaning service owner. So, like many of you, she is a successful, she's doing a good job of running her business. We know this because she's fully booked with customers. She has an excellent service reputation, but the financials are a difficult topic for her. This could be because at tax time, she doesn't have her financials in order, so she's got receipts, isn't able to quickly say how much she's earned, how much she's spent for the year. It could lead to trouble looking for financing, perhaps for an equipment loan. And right now, she might be operating as a solopreneur by herself, afraid to hire because what if things slow down? And in general, this lack of financial organization can lead to a lot of stress and overwhelm for a business owner like Sarah. So throughout this presentation, I'm going to be framing sort of stage of development as reactive versus proactive business management. And I say this is the core problem for a lot of business owners. You have so much to do, you have so much on your plate that it's really easy to fall back into this reactive type of management where you are fighting financial fires, dealing with the problems as they come up, and that leads to scrambling at tax time. You're going to miss opportunities, and it's just a stressful situation. If we can work to get more proactive with our business management, specifically around finances, what we're going to be doing is preventing problems before they occur. You're going to be more prepared so you can take advantage of opportunities, whether it be grants or loans or other types of programs that pop up. And hopefully you'll be much more confident in the decisions you make when it comes to running your business. So that is where we're trying to go, trying to move from that reactive financial chaos into a more proactive financial control. Again, this goes from that sort of we're a fireman mentality, right? We're putting fires out to more of like an architect where we are information data driven and we're prepared for growth and for funding, if that's something that makes sense for you and your business. So today's presentation is split into these 5 sections. These are our main learning objectives today. So we're going to start with the discussion of separating personal and business finances, what that looks like, some things to be aware of. And then we're going to talk generally about bookkeeping and what this could look like in its more simple format. And then move on to additional systems that you could use to track revenue, expenses, and receipts. Then kind of give you a little sample of financial reports and financial reporting, how we can use them to make decisions in your business. And then finally, to wrap it all up, how can we take all of the financial information that we've been gathering, tracking, reviewing, and use it to set goals and potentially even play with forecasting your cash flow. So we have a lot of topics today. We're going to try to cover them all. Like I said, after each of these sections, we're going to have a brief Q&A. So We'll be addressing the questions again throughout the presentation. Before we get into all that, though, I really want to talk about why does this matter? What is the cost of reactive financial management? What is the cost of acting like that fireman? Um, some examples that I've seen kind of anonymized in my experience as a business advisor are listed below. So maybe a truck driver wanted to apply for a loan, started the process, was sent to the SBDC because they weren't able to get approved because they didn't have tracking in place. They didn't have financial tracking in place. They couldn't prove their income. There's a restaurant owner who, when it comes to tax time, their records were in such rough shape and they didn't have the ability to clean it up quick enough. So they end up having to pay a CPA thousands of dollars in order to file on time. This could look like a consultant who's missing thousands of dollars in legitimate deductions come tax time just because they weren't tracked. This could be an online retailer who is ineligible for grants because they hadn't filed their taxes in previous years. This could affect your pricing. If you're a contractor and you're setting your prices based off of um, your actual spend, if you make those wrong pricing decisions, it can really have an impact on your profit. And then this is a big one that we see a lot of when it comes time where people might want to sell their business, but they haven't been keeping good track of their finances historically. That makes it a lot harder for someone to purchase their business at a good price to them. So a business owner may have to reduce the sale price of their company by a substantial amount because they weren't able to find a buyer who could get financing. So with proactive financial management, this can look a lot different. So examples include a food truck with clean, organized finances, able to quickly get an 85K expansion loan in a short turnaround. This could look like a contractor who used real costing data, able to increase their prices and increase their profit. This could look like an HR consultant who was able to build cash reserves because they have a seasonality to their business that without the reserves, they would struggle during that slow season, but they were able to weather the season confidently. And this could look like a photographer who paid their estimated quarterly taxes on time and no longer had to worry about a massive bill come April. So now we are moving on to our first main section, which is separation of personal and business financials. And this is really the foundation of proactive management. When I'm working with a business owner, this is often one of the first things I want to check is how clean is this set up for your business? What this looks like in this reactive proactive dichotomy is reactive is I'll deal with this later. You might have mixed accounts, meaning your mixed personal and business accounts. This has an impact on this has a potential risk to your personal liability. This can also have some credibility problems and lead to a lot of complications at tax time. The proactive approach is to set up that clean separation from day one, meaning we open up an exclusive use business bank account that will really help with your professional image, your legal protection, and simplify both compliance while allowing you to pursue growth opportunities. So that's what we're trying to do. And this is so important that I really want to drive this home. Why is this not negotiable? With legal protection, when you mix your personal and your business financials, what this can do is sometimes this is referred to as piercing the corporate veil, meaning when you create that LLC, you're creating a separation between you and your business. When we have this intermingling of personal and business funds, now you're actually leaving your personal assets at risk. Additionally, taxes are already complicated, so we should try to make it easier on ourselves with some clean records. And should you end up being audited, which nobody wants to be audited, having these commingled accounts can really weaken your defense and can potentially result in denied deductions. Again, professional credibility is a big one, and decision clarity, I think, is key here. It just makes it really hard for you as a business owner and for me as an advisor to talk about your revenue and expenses if we've got a lot of personal spend mixed in with our business. So, as a little aside, I want to carefully make sure we spend some time to think about what is an actual business expense, because this is something I get a lot of questions about as an advisor. First, business expenses, generally speaking, they should directly be related to generating income for your business. You should be able to explain in simple terms why this was both ordinary, as in an ordinary part of your type of business, and necessary to operate. So, some examples are provided below. I will say that this can be a little bit dependent on your type of business. Um, so, you know, keep that in mind, and always talk to a tax professional if you have questions about, is this personal or is this business? There is a bit of nuance to it. But generally speaking, things that do not count as personal expenses are things like your personal meals, gym memberships, hair appointments, family entertainment, personal media services, personal phone line, and commuting to your office. But the kind of test here is, would you still purchase this if you weren't in business? And if the answer is yes, probably it's personal. There are, like I said, there's exceptions to this list. So with industry specific exceptions, perhaps a gym membership makes a lot of sense. For example, if you're a fitness trainer, if you're purchasing makeup products and you are a makeup artist or even an influencer online, perhaps, and you're using these as very clear product placement, you can make this argument. But again, if it's unclear, talk to a CPA. So now that we understand the difference between business and personal, how do we actually do this? Here we're going through step-by-step implementation to make sure we are separating these personal and business financials. So step one is always to open up that dedicated business checking account. From there, we need to make sure we have a way to spend our business money easily. So this can be done with a debit card linked to that business checking account. It depends on your personal preferences on whether or not you want to have a business credit card. But getting a business credit card can help you build a separate business credit history, but it's not required for many business owners. They may just prefer to not rely on credit cards. Third is, now that we have a way to spend money, we need to make sure we have a good way to collect cash from our customers. And so to take some time to think through, how will customers pay you? It's best to use business dedicated accounts, so not personal Venmos, but you can get a business Venmo, or you can use PayPal, Square. There's also a lot of offerings through your bank. So making sure that it's a really clear process that revenue from your business will get deposited into your business account. And then, of course, all of you have started this business, hopefully, with the goal of generating cash for yourself, being able to pay yourself regularly. Whether that's through regular owner draws or salary, it's worth taking a little bit of time to make sure that's set up so you're not spending money directly from your business to pay those personal expenses. You already have it in your personal account. And then, just to make sure everything is clean and tidy, you want to spend some time making sure that any automatic payments and subscriptions are coming out of the right account, whether it's business or personal. So, a few common separation mistakes that I've seen is, it's easy, mistakes happen. You might be out at the store and you only have your business debit card. Things, that is understandable. What's important is that that's documented appropriately and you avoid making those mistakes in the future. But when it turns into habit, that's when we can see a lot of mess. Again, this is where we end up paying personal expenses with business cards. Another common mistake I see is inconsistency around owner draws, and you're not documenting them. So documenting an owner's draw can be really simple in a spreadsheet. If you're using QuickBooks, making sure we're categorizing our owner draws. Again, this is not salary, you're not on payroll. This is a non-operating expense, so we want to make sure that it's documented appropriately. And we want, ideally, you should be setting up your owner draw so it feels and acts kind of like a regular paycheck. So there should be some consistent timing, weekly, monthly. And if you're tracking this through a spreadsheet, just keeping a simple memo format of, how much you took, what the date was. And the reason for this is it can really show professionalism, maturity in business, especially if you're considering applying for loans in the future. Other mistakes are forgetting to update reoccurring payments, and of course, forgetting to track legitimate business expenses or reimbursements. So that is section 1. I'm going to take a pause, a sip of water, and I'm happy to address any questions related to this financial separation. Right? If there are no questions,
No
well,
questions.
no questions. I'll move on to the next section. So now we are getting into some basic bookkeeping. Again, we're talking about how do we move from this reactive chaos into proactive systems, and a lot of this not having bookkeeping in place or can lead to a lot of stress, especially at tax time, which I think people are feeling right now around the end of the year. We can also see stress, errors, missed opportunities, and then, of course, having to pay someone else to fix your mess. If you're proactive, and that can lead to you knowing exactly where you stand at any point of the year, can have more confidence, you're going to make better decisions, and the information, your financial information around your business is going to be a strength for your operations. I see some questions from the last section coming in. I'll be sure to address those in the next pause. So I like to remind people that bookkeeping has existed long before QuickBooks software. So I want to talk about how bookkeeping can look like a lot of different things. At its most basic and not recommended, I'd say this is level 1. This is where a lot of business owners might start, where you are running your business just off of your bank balance. You want to buy something for the business, you open up your online account and you say, hey, I've got some cash, I can afford it, I'm going to purchase it. There's a lot of issues with this approach. So really, I encourage folks to move along this spectrum, at least to level 2, where you're loosely tracking your revenue expenses. Some folks even do this by paper, pen and paper, which I think, again, it can work if things are really simple for your business. But today, I'd really like us to focus on how do we get to at least level 3. And level 3, I'd say, is keeping a detailed spreadsheet where you are tracking your expenses, your revenue, hopefully also your owner's draw. And I'll show you some examples of that. Beyond level 3, I'd say level 4 is kind of an intermediate. There are some free or basic accounting softwares available if you're not quite ready to take that leap into using QuickBooks, Xero, or a similar type company. But where we see most businesses ending up is level 5, and I'd say it gets more complicated after that. But I'd say using QuickBooks or a similar type software is definitely recommended when you start to see a high number of transactions, where you might have a more complicated business model, meaning maybe you have several different types of revenue streams. You might be managing several bank accounts, several credit cards. You could have loans outstanding. So once things start to get to the point where just a spreadsheet is going to drive you crazy, it's a good sign that we should be moving on to a software. So again, we're talking about mostly that level 3 if you're tracking by spreadsheet. Well, I want to make sure we cover what are the essential things to track. I've seen a lot of people just make a list and write down their expenses and tally them up, but that's missing some, I'd say, crucial pieces of information. So when it comes to tracking, whether it's revenue or expense, I'd say we really want to make sure we're tracking the date, as in the date that cash is either entering or exiting your bank account. We want to track either if it's revenue, who is paying you, or if it's an expense, who are you paying? Of course, the amount, most people have that covered. But then ideally, we also want to think about this in categories. if you have different types of income, how do we separate out those different types of income? That can help us make some really critical decisions. Same thing with expenses. Is this a software expense? Is this, a rental expense? What are some general categories we can use? And then it's nice to have a little description, optional, if there's some different things you wanted to remember for later, maybe at tax time, and potentially payment method. Did you pay by credit card? Did you have to use your personal funds and need to get reimbursed? Which bank account did it come from? Things like that. So some common expense categories we see. And again, today we're talking about financial basics. We're not talking, we've got a different webinar on financial statements that goes into a lot more detail on expense categories. But as a quick overview, some common expense categories include cost of goods sold, sometimes known as cost of sales. Not all businesses track cost of goods sold or cost of sales. Most often, this is thought of for businesses who manage inventory, have really clear direct costs associated with their revenues. But if you're, for example, if you are a single operating consultant, you probably aren't tracking your cost of goods sold, right? You're charging service fees, and then most of your other expenses are operating revenue. But again, I want to focus that these expense categories are really dependent on your business, but these are some common ones we see across a lot of business types. So that includes office supplies and equipment, marketing and advertising, travel and vehicle, professional services, insurance and utilities, and then owner's draws. I put an asterisk here because, again, owner draws, I recommend these being tracked separately, as these are not considered operating expenses if you're not actually putting yourself on payroll and paying a salary. These would actually go on your balance sheet or your statement of cash flow as an equity expense, because this is you pulling equity or ownership out of the company through paying yourself. Okay. I'll also be including, and after this presentation, you'll have access to this PowerPoint as a PDF, and you'll have access to a template that I like to use to track revenue and expenses. This might have more than you need, but we have a setup tab, setup and instructions, where there's notes on what to do. You can update all of these to reflect your actual bank accounts, your actual revenue categories, cost of goods sold, operating expenses, etc., if helpful. Otherwise, just using this as a example on what you would want to track, how that might look in Google Sheets or Excel. And again, tabs for revenue, expenses, owner draw. Now, if you use this diligently, this is also linked to an actual summary profit and loss statement, but I'm not going to get into that in too much detail right now. But I want to share that is available. The template version that I just showed, and an example, which is what we're going to be talking about here. So first, with our revenue tracker. Step one, it's worth spending a little bit of time before you just dive into tracking your expenses to think about what are our categories, our revenue categories. And I saw someone in the notes say that they are currently using spreadsheets. They're planning to transitioning to QuickBooks in the coming year. Taking the time to do this on a spreadsheet can really help you as you transition into QuickBooks, because you've already started to think about how what we call your QuickBooks chart of accounts is set up. So it's not just the default revenue or income or sales. Maybe your business has a couple discrete categories that you'd want to track. And simple is often better. You don't want to have 100 different revenue categories. Most businesses, I'd say, wouldn't want to have more than 3 or 4, but spending a little bit of time thinking through what you want that to look like is often worth it. Now, when we think about our expenses, this is a little bit more complicated. But again, we want to spend that time defining these expense categories. So in that spreadsheet that I shared, you have the ability to edit the names of these categories. You notice I have a preference for broader categories. So I like taxes, licenses, and registration, That would include paying your annual business license, which is technically a local tax. Maybe if you have to register your LLC, things like that. It's all a broad category kind of lumped together. Same thing with software dues and subscriptions. A general category, and this I find a lot easier and cleaner to look at in the future, whereas if you were to have, music streaming software or all of these different subcategories of software, it gets really messy and hard to see general trends. So again, simpler is often better. And again, I recommend tracking those owner draws separately. You don't need as much information with the owner draw, just the date, the amount, and notes if you feel like it. Also, on my tracker, I keep this column to remind us that technically we should be saving all of our receipts, or at least maintaining access to receipts related to any business expenses, should we need them for an audit. So what I just showed you has a monthly summary. So that comes from having everything else filled out. These are really the main things we're trying to pay attention to. What is our revenue, our total income for the business, revenue or income interchangeable? What are our costs of goods sold? If we have costs of goods sold, what is our resulting gross profit, operating expenses, and net income? And then for most businesses, what we really care about is cash. So we might be wanting to track starting cash, change of cash for the period, and an ending cash. I find it helpful to review these finances at least monthly, so we can look at these monthly summaries, so we can be ahead of any decisions that might be coming. Now that requires being on top of your financials, and a lot of business owners I know try to aim to have their prior month's financials tracked by the 15th of the following month. So by February 15th, your January is clearly documented, good to go. So in the spreadsheet that I use, I wanted to explain the most complicated formulas that I'm using. Some of them are simple sums. For folks that are curious, the most difficult one is probably a sum ifs, which is pulling information from other tabs. In this example, the revenue tab, and moving it into the summary tab. And what a sum ifs function does in Google Sheets or Excel is it adds up numbers that meet certain criteria. So if you're looking for a challenge and stretching your Google Sheets, Excel skills, that's a formula you can try to pick apart. And then some of these key general formulas that I have included in the summary are gross profit. So gross profit is revenue minus COGS. Again, this business example doesn't have any cost of goods sold. So your gross profit and your revenue are actually equal. And then your net income, which is sometimes referred to as net profit, is taking your gross margin, your gross profit, and subtracting out your operating expenses to get your net income. Now, your net income is a guide of about how much you'll owe at tax time, depending on other deductions you might be able to account for. But all of that comes together to affect what's happening in your bank account with your net income plus any other non-operating changes to cash. So a challenge question here, if you've been paying attention, is if net income was 331, why was the ending cash only 181? So what else could be going on based on what we've talked about that would have impacted our change in cash? I'm going to pause. I know I'm not actually expecting anyone in the Q&A to jump in, but remember, owner draws are tracked separately. These are non-operating expenses. So in this example, probably there were some owner investments and or owner draws that were affecting that cash. All right, moving on. So when it comes to bookkeeping, something that I often see people miss is whether they're using spreadsheets or even if they're using QuickBooks is the reconciliation step. So what reconciliation is about is making sure that you can reconcile any of your balance sheet accounts, but most importantly, your bank accounts are the ones we want to be thinking about. And what we're checking is that your calculated cash in your bank account matches what your bank statement says. Now, most bookkeepers do this on a monthly basis. And the way they do it is they look at the bank account, or they maybe download the bank and credit card statements, and they check and see that all the transactions that they documented are included in the bank statements and vice versa. And they will find and fix any differences. They know that they're going to be wrong if the bank statement has more or less cash than either QuickBooks or your spreadsheet shows. Now, if this feels confusing right now, it is confusing if you're new to bookkeeping. So I'd say just know that this reconciliation step, if you're using a bookkeeper, can really save you from mistakes in the future. And the things that might push your reconciliations to be more difficult would be if you forgot some minor expenses like bank fees you didn't record, or if there's some timing issues, maybe you recorded a deposit but it hasn't hit your bank account. Maybe there were some automatic payments that you didn't record that were just automatically taken out of your account. And in QuickBooks, this can be related to matching transactions. If you have questions about this, there's an upcoming QuickBooks webinar. So plenty to discuss there. But why all this matters is if you're not doing something to check your bookkeeping and make sure that you have clean data, your reports aren't going to be reliable. And you won't be able to make confident decisions because your reports aren't accurate. Two, if you're applying for loans, other sorts of grants, things like that, you're going to be under some additional scrutiny if things don't add up. So now, at the end of each of these sections from here on out, we're going to be talking about some things you can be doing in sort of little bites, weekly, monthly, and quarterly, to handle all of this, because I know it's a lot. And so for part one of this, related to our basic bookkeeping that we've talked about, again, whether you're on QuickBooks or whether you're using spreadsheets here, weekly, this looks like spending 15 to 30 minutes updating your revenue and expenses from the prior week. First step here is to pick a day and time and stick to it. I've known people who do Money Mondays or Financial Fridays, and just block that time off on your calendar so you've got that structure. Monthly, there to be some sort of a reconciliation or a double check with your bank statements that you didn't miss anything. And then quarterly, this is a good opportunity to review, how's your bookkeeping system working? Are your categories up to date? Are you struggling? Do you need just a little bit of help? You can reach out to an SBDC or Capital Pathways advisor to help you think through your systems. All right. Whew. Made it to another Q&A. So I know we've got to go back a little bit and talk through some of the prior sections. We'll start there. So I'll start with first question. How do I use the same QuickBooks for my personal and business since my LLC basically functions as a pass-through entity? So I've seen people do this, and it is a big headache. It is not recommended to use QuickBooks for your personal financials. We want that clear separation. So the only bank accounts linked to your QuickBooks should be those exclusive use business accounts. The only credit cards linked to your QuickBooks should be exclusive use business credit cards. If you have them linked, for example, if you have personal bank accounts linked into your QuickBooks or personal expenses being shown in your QuickBooks, QuickBooks, one of the cool things it does is it helps you generate some of these more complicated financial statements, like a balance sheet. Your balance sheet shows it's like a running history of your entire business. That balance sheet's going to be totally thrown off by including your personal information. Also, if you were to ever want to hire a bookkeeper or a tax specialist or someone to review your books, you're allowing them to see all of your personal information, which most of us would prefer not to do. So QuickBooks is meant to be used for exclusive business use. If you have more questions about that, definitely recommend talking to an advisor. Next question is, what if you bought inventory to start business before you opened your business bank account? So that absolutely happens. People can be generating some business expenses, that this is the time where I say definitely have a clean spreadsheet tracking those business expenses, and note that you use personal funds. Save those receipts because this is proof of early stage owner investment. If you don't have a business bank account, you can't spend money from a business bank account. So if you are spending that cash, again, track it, save it, document it, because you should be able to claim tax deductions based off of those startup expenses as well. So you don't want to miss out on those tax savings. Next, so I don't want to answer specific tax related questions, but we're going to say this is a hypothetical question about a conference for business. Can dog boarding be considered a business expense? So again, ask yourself the question, if you didn't run and operate this business, would you have had to pay to board your dog? That is my test. I'm, again, not a tax advisor. If you are claiming it as a deduction, you want to document the business purpose, you want to maintain receipts, and if you're working with a tax advisor, you might flag that one as, hey, are we sure this is defensible? I can see an argument either way. But next question is, if I open a small retail business, does the point of sale system feed directly into QuickBooks? So this depends on which point of sale system POS system you're using. There are tons of systems that integrate directly into QuickBooks. Not all of them do. And if you're using, there's like a freelancer version of QuickBooks that has really limited features, that one probably wouldn't work. But QuickBooks Essentials, your lowest tier of your regular tiers, should allow you to basically sync up those systems, again, depending. So you're going to want to look for apps or integrations. And you can Google the point of sale system. I would recommend like Google Square QuickBooks integration or whatever it might be, and see what that would make sense if there's information there. Next question. I am a founder, executive director for nonprofit. We are looking to expand and set up a storefront, which may require more assets to secure a place. I'm willing to offer the nonprofit an interest-free loan from an account only in my name. How would you recommend I do so? Okay, so if you are documenting these sorts of owner investments, owner loans, you want to approach it as professionally as possible. I'd say this is a great opportunity to work with Capital Pathways and talk to their free legal resources. As ideally, you want to make sure you have good paperwork in place that clarifies the loan amount, the payment terms, sort of like the expected payment schedule, and that the nonprofit book, the entity receiving the cash, is documenting the amount appropriately, which should be a liability on their balance sheet that they owe you money. So, definitely this happens a lot, and you'd be setting yourself up to get paid back, which is smart. So I'd say just understand clearly how you want to be repaid, what timeline, and speak to an attorney regarding the paperwork. Next question is, how much should hiring a bookkeeper cost for a single person company? This is hard. I'd say you can always find a deal, but oftentimes you get what you pay for. I've seen people pay anywhere between like $250 for really cheap bookkeepers, either like through online sort of Upwork, almost like scenarios. That's probably the lowest end. Up to $1,500 a month for a more complicated company. So as a single person, simple company, assuming you don't have any craziness going on, I would probably set my budget right around $500 and be willing to entertain slightly higher costs if the bookkeeper, defended it, seemed more, specialized, competent, etc. But that's the frequent range I see is around $300 to $600 a month for a basic bookkeeper. And if you're thinking about how much you should pay and evaluating should you hire that bookkeeper, I recommend starting with how much time would it take you to do their job in hours. And if you don't have much bookkeeping experience, it could take you like 20 hours. So it's well worth paying someone else who could do it faster. So evaluate your time investment as well. Okay. So now moving on to the next section, which is talking about some simple systems in addition to, our bookkeeping systems that can help us track revenue, expenses, and our receipts. Now, what I'd say is this is difficult to answer in an all-encompassing general sense for all types of businesses because really what I recommend is doing some research and choosing the tool that's right for your specific business. For example, if you are in retail, like product sales, a lot of folks are happy to sell on Etsy. Etsy has a lot of built-in features. For example, you don't have to worry about sales tax on Etsy, which is really nice. But maybe Shopify or Square makes more sense. They all have kind of different associated fees, but also different benefits to a business owner. So it depends on your goals. Maybe you want to use multiple. Maybe you want to start with one, transition to another. But definitely worth exploring those various tools. And another topic you could talk to an advisor about if you're having trouble deciding. For restaurant and food, the big ones we see obviously are Toast, Square for restaurants, Clover. But if you are starting out a restaurant, there are other sorts of point of sale systems that are through more personalized brokers that might make sense if you've got online sales and in-person sales and you've got a more complicated system. For service businesses, some folks you might need to manage appointments, so that can be done sometimes through Square Appointments, Jobber, FreshBooks is another tool I see people use a lot. Again, in the trades, that's another sector where I see really specific types of systems that help you track revenue for your business. Again, in creative type freelancing works, Etsy, FreshBooks, PayPal are all common. And in consulting and professional, we might just see if people rely on QuickBooks or their accounting software to track their revenue. That might be enough. That can also be done in other sort of QuickBook Lights equivalents. So again, think about your customer when you're considering different revenue tracking tools, but also think about yourself. How easy is it for them to pay, and how easy is it for you to review those transactions? And then we need to compare pricing, compare things like, does this integrate to my bookkeeping software? And stay curious. Now, some businesses might not need any of this. You may only need your accounting software, Wave or QuickBooks, while other businesses will really, really benefit from working with platforms that handle sales, scheduling, or inventory, memberships. Like if you're a gym, most of these payment platforms, they do not replace a QuickBooks because they probably don't track things like expenses. They don't handle things like owner draws or equity or things like that. But a lot of the paid ones will integrate directly into your accounting systems and can be set up automatically. When it comes to expense and receipt tracking, this is really about audit proofing your business. Nobody wants to be audited again, but if a lot of these operations can be thought of if I were to be audited tomorrow, would I be comfortable defending my prior year financial decisions? And tracking receipts is one of those things that would really, really help if you were in that situation. There's from the simplest, always recommend immediate capture of receipts, just so meaning take a picture as soon as you have the receipt or save it on your phone or put it in a folder. This can be done manually. Or there's some apps that can help you with this organization. At its simplest, this is dedicated folder on your phone for business receipts. But apps like Expensify, Receipt Bank, or QuickBooks Mobile can help if you're looking for a more sophisticated system. Even more advanced, there are apps that auto categorize and integrate with your accounting. So we can talk about that if it's an interest. But no matter what, when we are collecting receipts, I want to make sure that we are finding a way to track the business purpose. So, excuse me, it can be helpful just to write on the receipt or to write on the description, the title, lunch with so-and-so doing this. The more hints you leave yourself, your future self, the easier it's going to be. Now, there's additional tracking situations that you might run into as a business owner, again, depending on what your operations look like. A lot of businesses, you might be using a personal car. So when it comes to tax time, you'll be able to either claim mileage or actual expenses, but you can't claim both, obviously. For a lot of businesses, mileage is usually simpler for tracking, meaning you need to have a mileage log, how many miles are traveled. There's apps that do this. You can use a paper logbook or a spreadsheet, and then you can multiply that out by the mileage rate and claim that annually on your taxes. Now, if you have a lot of cash transactions in your business, keeping a daily cash log, or you can just be depositing it promptly into the bank. You want to be tracking the payment and receipt, the payment receipt and customer info for those cash transactions as well. Other common tracking challenges or it might include home office deductions and how that's being calculated. Again, there's an upcoming webinar specifically on preparing for filing taxes. So I'm not going to spend too much time talking about these tax deductions here. But keep in mind, you have the option with home office to either use a simplified method or the other method, which includes calculating the actual cost and prorating it based off of the size of your home office. And this can apply to other mixed use items as well. Additionally, there could be client reimbursements. If you are purchasing things on behalf of your customers, it's recommended not to track that separately and not to count it as general income. So. After all of that, I wanted to go back and revisit our time-saving systems. This looks exactly like it did at the end of our last section, except now we're going to include to that weekly checklist, let's also add a reminder to log into tracking tools, check that your receipts are up to date, and update any specialized trackers you might have. So with that, we are on to our next Q&A. So I've got one question. What is a good POS for a food trailer? I'd say, again, that you'll see a lot of your typical restaurant toast square for restaurants, but there are going to be more. I'd say look at the different tiers of pricing, look at the fees, compare and contrast what other features might come with it, and do your best to shop around a little bit before committing to one. Next question is, can bookkeeping and tax-related filings be done by a single service provider / accountant or hired separately? So yes, there are absolutely CPA accountants that will do both bookkeeping and tax filing. They are typically more expensive than bookkeepers. Folks that you hire to file your taxes, I recommend they should be tax professionals. They should be CPAs. Whereas a bookkeeper doesn't actually need to have that CPA. They don't necessarily need to have any certifications. They just need to know how to use QuickBooks. So there are some folks who use a cheaper bookkeeper around the year, and then they hire a tax CPA at the end of the year to file their taxes. And there's other people that might stick with that CPA all year for the bookkeeping and tax services together. It really depends on the financial company, the certifications of the provider. Now, this one, interesting. This is a very specific example. I'm not sure if I can answer, but if I used a personal car for client meetings and you get a flat tire or a mechanical issue, can I include that as a vehicle expense tracking? So I would interpret this as, again, we have the choice when we're using a personal vehicle when it comes from a tax perspective to document actual expenses or mileage. So if you're documenting mileage, I'd say probably not. But if you are documenting all of your personal vehicle expenses, and then you're basically taking the percentage of your all of your annual personal vehicle costs, insurance, oil, maintenance, all of that, and then saying I use my car 25% of the time for business, you'd want to work out which one saves you more money on taxes, probably. But um, when in doubt, and you're if you're filing with a tax professional, track it. Save the information, save the receipts, and then ask the question, hey, is this a valid business expense? Because when you're working with that CPA, they're there to help back you up. If you get audited, again, they're there to support you through an audit. So again, I'm not a tax professional, I'm not a CPA. So I will keep it general. So now on to our next section, talking about some financial reports basics. So not going into a ton of detail into all the various financial reports, but we kind of breeze over them at a top level. These again, when we talk about our financial statements, this is basically our business dashboard. Similar to operating a vehicle, your car has gauges, your business also has gauges, and our financial statement is an equivalent to that. So your car's dashboard, it tells you, are you driving too fast or too slow? Do you have enough fuel to make it to your destination? Is your engine overheating? Is your vehicle in major trouble? And your business dashboard, your financial statements, can tell you your profit. Are you making money or losing money? Your cash flow. You know, do you have enough cash to make it through slow season? Comes to your cash flow statement. And then it can also tell you trends. Is your business growing or declining? Is it healthy? Is it struggling? So uh, we, for today, and what we're going to talk about here, the main reports we want to monitor are your income statement and your statement of cash flow. Most business owners are more comfortable with their income statement than they are statement of cash flow. But again, I recommend trying to check out both if possible. So starting with the income statement, this is also known as the profit and loss. Sometimes you'll hear people just refer to it as a P&L, but by most people's measures, it is the most important report for small business owners. In its simplest form, it is revenue, all of your earned money minus all of your operating expenses or all of your money spent on operations. And that is equaling net income or what you actually made, your profitability of the business. I wanted to make a quick note that you'll hear terms like net income, net profit, EBITDA. All of these distinctions are clarified in the financial statement bootcamp webinar. But for today, keep in mind they're roughly equivalent for how we want to be talking, how we'll mainly be thinking about them. So when reviewing an income statement, I also highly recommend looking at it on this monthly view. And the reason to look at it across months is because this gives us the ability to evaluate trends in our business. Are you generally earning more revenue? Are your expenses generally staying flat or tracking your revenue? What about your net income? If you're looking at a detailed P&L, this is just a summary. You'd be able to see, which expenses might be growing really fast. A common thing I'll see in businesses that are growing is sometimes software costs get out of control really fast. These are monthly subscription charges. A lot of them are automatically pulled out of your bank account. So making sure that we're taking the time to look at this statement and saying, like, do I understand every single one of these expenses? Is there anything I can cut? Am I operating my business efficiently? And how does this compare to last month or last year? So even if you might be working with a bookkeeper, they'd probably be sending you your income statement, your profit and loss on a monthly basis. Absolutely, you should be taking the time to review it, look for things, ask them questions. If you're putting this together yourself, even more important to make sure you understand every number that comes across. And if you're not, book some time again with your Capital Pathways or SBDC advisor. Now, I also want to touch on profit and loss doesn't cover everything. This is why a statement of cash flows is also important. And cash flow is again is like your fuel gauge. So if you notice on your profit and loss, there is no bank balance here. We don't know if you have $100,000 in your bank account or $2,000. You can't get that information from a profit and loss, but it is shown on your cash flow. So we want to talk about this because even good businesses can still struggle with cash or even potentially run out of cash. And there's some common challenges and some techniques to handle it that I wanted to touch on briefly today. And the first is customer payment timing. So if you have to invoice your customer first, and then you perform your service, you're going to generate expenses, and then your customer pays you after. There's that lag. You could see things like, especially in government contracting, 60 to 90 days to get your payment. So as you're setting up your business, we want to make sure you really clearly understand your payment timing. Do you have enough cash in your bank account to execute on the services you're providing? Collect that cash. And then, are you also doing a good job of cash collections? Because this is an area where I see folks really struggle. Next is owner draws. Again, owner draws are not documented on our P&L. And when you take irregular pay, then this can have some unexpected effects on your cash flow. And so if you plan for owner draws ahead of time based on your expected cash flow, you can be in much better shape. Credit card payments can also muddy the waters when it comes to cash because your monthly payments might not match up with your monthly spend. There's that lag. And I'd say this can be avoided by not over relying on your credit cards or debt, and instead, make sure that you're paying those credit cards on a timely basis. Not overspending just because you have the credit available. And additionally, we have fixed expenses that are going to be regular, no matter if it's slow season, busy season, what have you. So we want to make sure that you have a good understanding of what your monthly reoccurring regular expenses actually look like. So to update our time saving systems, what this is going to look like is just including on a monthly basis, reviewing these key statements, your income statement and statement of cash flows, ideally. And if you don't understand them, talking to an advisor or talking to your accountant, whoever's available to help you understand what these statements are trying to tell you. Okay, so now taking another pause for questions before we move on to our last objective. And it looks like we are thinning out. I know a lot of people had to drop off at 1, but first I have a question on owner draws. So is there a typical percentage used to calculate what an owner draw should be out of the net profit, and how often does an owner typically take a draw? So I'd say a lot of these answers are going to be, it depends. If you are the type of person who really likes to have those clear percentage set apart definitions, I'd recommend this book. It's called Profit First. It is a specific methodology on taking you based on the revenue that you have coming in, designating percentages that go towards different categories, including profit, owner's draw, owner's salary. Now that's really prescriptive. And it's going to be different for different businesses. So I think from when I work with most business owners, I ask the question instead of how much cash do you want to be able to pay yourself on a monthly basis? And we start there. And then we look, can the business afford this? Because I do like to think of what can a business afford for like a regular owner draw? And maybe that's, maybe that's 4,000 a month. And then on a quarterly basis, you can look and see, is my business profiting a lot more? Do I have a lot of extra cash? Then we can take some larger sort of profit distributions. And I see in the chat, we got a thumbs up for Profit First. So again, if you like the systems It can definitely help support some clear frameworks. But pause here. I don't know. Well, Lena, will I get in trouble? Am I plugging a book? But
No, that's fine. I am going to put it in the chat.
good, good. Uh, so there's a lot of different methodologies to think about how you should be paying yourself. Um, a good rule of thumb around paying yourself is, again, it should look and feel like salary. So a lot of people pay themselves on the 1st and the 15th of the month, setting those days and sticking to them. Maybe monthly is good enough. So I would rather you set up a system that can be reproducible and can expand with time and mature as your business matures than setting yourself up with something really complicated. So let's yeah, try not to try to set ourselves up for success and slowly kind of turn up the dial on complexity. Someone asked is if I wasn't able to attend the whole session, will there be a replay link? And absolutely, after this webinar is over, you will get the slides. You should also get a link to the recording. And I welcome you, even if you were here the whole time, to rewatch the whole thing. Right. I think I've got all those questions. So moving on to our last learning objective, number 5. So how to set goals and forecast cash flow. Now, this is really moving from hoping to planning. You can't do this step without having done the prior steps, right? In order to set goals and using your business financials to make decisions, you have to start by having good tracking systems, system that you trust. You have to be pretty confident in how much revenue you made, what your expenses were, what you were spending money on. So it's worth spending the time on those fundamentals so we can get to this part. Again, reactive versus proactive. A reactive approach here is, ooh, I really hope this year is better than last year. It is wishful thinking. You don't have concrete targets, and in a sense, you are flying blind. Now, if you're proactive, you can set specific targets based off of real data. Maybe last year you generated $50,000 over the course of the year. And it's as simple as saying, I know that I did 50,000 last year. On average, that was a little less than, is that 50,000 divided, a little less than 5,000 a month. Is that right? Whatever. And then you can set your goal to be next year, that you want your average income to be 6,000 a month. And what does that mean? So we're using actual like smart goals based off of past performance. And these are measurable. So you can say, did I hit this goal or did I not hit this goal? And as the year is going on, if you're looking at your expenses monthly, then you can course correct if you're not quite trending towards your target. Now, if you are working on setting goals, I recommend approaching them in this order because from left to right, they kind of build on each other. So starting with, for most people, the simplest goal to set is revenue targets. This is where you have most control as a business owner because you can manage how much effort you put into sales, how you contact your customers, etc. And you can also use past historical data. And if you're a startup, you can use industry data and your general growth plans and customer targets. So starting with revenue targets, we can be setting some goals. Second is expense management. This is about cost control before it creeps up and starts to kill profit. So first we're thinking about how much cash are we going to be bringing in, but then we're thinking, all right, how much am I going to be spending? What's my budget? What's the max I'm allowed to spend on travel or sales and marketing or what have you? Next, we can be thinking, once we have the revenue and expense in place, we can be thinking about profit improvement. This might be our pricing. Small pricing changes can have huge impacts on our profit gains. Once we have all three of these, now we can start thinking on a little bit more long-term basis. Do we want to build an emergency fund? It's recommended for a lot of businesses to have a few months of operating expenses available should something happen. Most of you running a small business, you are your most important business asset. So if you get sick or a family member gets sick, could your business survive you being light touch or unavailable for several weeks? For a lot of business owners, the answer is no. So how do you make sure that your business can weather uh, whatever happens? And then if we have all of that, we can start thinking about growth investments. It is much cheaper to save money and invest in your own business through profits than it is to get a loan from a bank or to try to find an investor. So if we are doing all of this early on, you can reduce the amount of debt you might have to take on or might want to take on, and you'll really know exactly what you can afford to expand. Bottom line, you can't plan for growth till you know your numbers, and these all build up on each other in this consecutive sort of fashion. Now, when it comes to making these growth-based decisions, we're getting into cash flow forecasting. When we're running our business in a reactive way, we're going to say, I'll find more cash if I run out. I'll take out a line of credit, or I'll loan money from my personal account. I'll find cash if I run out. If you're proactive, you should be looking ahead at least 3 months and saying, I'm pretty comfortable and I know that my business will be able to weather the next 3 months given some uncertainty. So, step one in forecasting our cash flow is thinking about our revenue. So, this is and our revenue as well as any other cash inflows that could be expected, but mostly this is revenue. So it is your known income. Do you have a certain number of customers that pay the same amount every month? If so, projecting revenue should be fairly simple. Um, do you have additional sales targets you're trying to hit? If you're trying to double your customers, then you should be able to say, hey, I made 5,000 this month. If I double my customers, I can make 10,000 next month, right? Then making sure we're also thinking about the seasonal adjustments here, because maybe your business is like, if you sell pies, right? November is probably going to be a crazy month, but January might not be so profitable or so busy. So how does that affect your business? And this, again, we're just thinking about 3 months at a time. So you should be able to think through those, how that could fluctuate. And then do you have any other sources of cash coming into your business, whether it's because you're planning to invest or you're getting a loan or a grant or anything like that? So cash in first. Step two is cash out. If you've been tracking your expenses regularly, you should have a general idea what your monthly operating expenses look like. So we should be able to think, what does that look like? And then are there any other planned expenses that you wanted to purchase or wanted to start using that you hadn't in the past? If so, we can add that in. And then we want to make sure we're also thinking about those expected non-operating expenses, like owner draws is the big one, but it could also include loan payments, equipment purchases. So then it comes to calculating, what is our starting cash? What is our revenue in? What is our expenses out? And what does that make our ending cash equal? Now, the template that I showed earlier does have a tool to do this. This is our budget, P&L, and cash flow. At the bottom, if you've gone through the setup and instructions, the categories will all be what is on your P&L, your profit, your actual P&L. So it's just a matter of going through and filling out numbers in these cells. So you can do this here and it'll flow through and give us this sort of cash flow statement mini here, which will give us our starting cash, changing cash, ending cash. So this is a tool you can use, you can play around with if you're interested. But what this looks like in detail is, for step one, what is our known income? For this example business, known income is 0. Brand new business. Expected sales, 0 for, sorry, we're thinking about January. Expected sales, 0. I'm just starting up. I'm not expecting to get any customers yet. I'm not going to add anything for seasonal adjustments, but I know that I'm going to invest a bit of money, and this is my first month of operations, into my business, $500. So step two is cash out. My expected operating expenses, I went through, I made a list. It's $340. I'm not going to take owner draws. I don't have any other non-cash payments. So I can calculate my starting cash. This is much easier. Sorry, I'll calculate my ending cash. It's much easier using a spreadsheet tool because my starting cash was zero. I added $500. I subtracted $380 for expenses, and that led to a $160 change in cash. And this can be done just 3 months at a time, right? Not too scary. We don't have to predict the future really far out. Another tip is I recommend using formulas where it makes sense and thinking about what are our unit sales. For this business example, I'm a bookkeeper charging $500 a month. I think I can get my first customer in February. I think by March I can have two. So that's how I'm getting to this $1,000. I'm tracking separately hourly consulting because I think I can charge $100 per hour. I think I can find a way to offer 10 hours of that hourly consulting. And so that's how I'm getting to a March projected income of 2000. So I know this is a lot. This is an introduction to cash flow forecasting, something definitely to work with an advisor one-on-one with if there's an interest. Now, we are all here, Virginia business owners. We absolutely have some intense seasons in Virginia, both related to the weather, but it's not always weather related. For tourism businesses, we do have beach season, fall season, autumn, skiing, things like that. Obviously, agriculture, very weather dependent, as is construction, but retail, we're dealing with holiday seasons, back to school. For professional services, if you're a bookkeeper, tax planning, year-end planning, that's going to be a big impact. And also, something that I think people forget about with seasonality is your own availability, especially if you are a small business owner and maybe you don't want to work in December. Then you're probably not going to have sales in December. And we should also factor that in. So, this is offering an action step here. If you don't know the seasonality of your business right now, you can take a look at your past 12 months and see when were your high and low revenue months and plan your cash reserves around your slow season. And make note if you are surprised what's going on, try to dig a little bit deeper. What was driving any dips or surges that you might see? Now, here I'd like to introduce a growth planning framework because this is where we're all trying to get to, being able to use our financials, use our financial understanding, our business to make big decisions around long-term growth or even sustainability. But not everybody wants to grow $1 million or $5 million, $10 million business. Maybe you just want to grow something sustainable that allows for you to pass something on to sell in the future. So first, know what you're growing, what you're working towards. But no matter what type of business you want to have, there are ways to work towards it in a careful way. So first step is always using our financial data, having that financial data accessible. And then we want to start by looking, do we have those cash reserves available? If you don't have cash reserves available, if your business is living month to month, revenue to revenue, what can we do to build those reserves? If you have the reserves, is your business consistently profitable? If not, then we want to evaluate your expenses. What can you do to boost your revenue or cut costs? It really is that simple a lot of the times to build a more efficient, sustainable business. If you're profitable, are you growing at the rate that you want to be? Again, maybe your goal isn't to grow, but if your goal is to grow, what does that look like? Are you staying flat? Now, if you are not growing as much as you want, what can you do around low cost sales or marketing that can increase your number of customers, increase your revenue? If you are showing solid revenue growth or growth making you happy, is your debt manageable? If your debt is not manageable, you should really be aiming to pay down or consolidate debt. But if it is, now, okay, amazing. We can make some big growth investments. We can think about hiring employees, purchasing equipment, bigger marketing or branding campaigns. You might be thinking about it's time to expand to a new location. But following these steps first keeps you from taking bigger risks than you might want to. So, after all of these, I'm going to want to share a sample action plan for you that you can take away from this webinar based off of the topics we've discussed. So starting this week, if you don't already have a business bank account, absolutely, let's go get that set up. If you don't already have a good bookkeeping system, let's get it set up. If you have one, but you got some ideas today about how it can be improved, let's implement those changes. If you haven't been gathering receipts, let's take a little bit of time to look back at least over the past few months to gather or organize those receipts. Let's set yourself up for success by blocking off 30-minute time blocks monthly and even just 15 minutes a week that'll reoccur and is guarded can be a huge help in starting these processes. And then as needed, recommend scheduling time with an advisor or mentor to help you stay on track. Again, are doing this a little bit all at once. I recommend these steps on the weekly, monthly, and quarterly basis to keep you on top of your financials so you're not scrambling. And we're going to go back to Sarah and say that she attended this webinar. She made some adjustments. She didn't do it all at once, but slowly she made simple and effective changes. What does her business look like 6 months later? She was able to open a separate business account. She set up her own bookkeeping or reviewing routine. She got a much clearer picture of her profit every month. She was able to build up a 4-month emergency fund and hire a first employee. The results of these steps that she took on her own or with the support of an advisor was that she was not panicking at tax time. She was approved for a loan, started sleeping better. She was able to start paying herself a steady salary, making decisions better based off of her data. And she had more time to work on the business and not just in the business, which I think is a lot of our goals here. So now it's on to you, starting with this week's action items. I want you to work towards building a more proactive business foundation. I've got to plug, of course, some upcoming webinars. These are all through Capital Pathways program. This week of December 15th through 18th looks jam-packed with some solid topics that I think can be applicable to most small business owners I know, QuickBooks 201, SBA loan programs. And then we get a lot of tax questions. So what can you do right now with just a couple weeks left of the year as of December 17th to reduce your tax burden? And then also discussion on LLCs, S Corps, and partnerships, making sure that you have the right business structure for you. With that, happy to take any questions. And a final plug reminder that when you exit this session, you will be directed to a survey. We would love you to share your feedback, offer suggestions for new topics, share what you liked, share what was confusing. And of course, reach out to folks who reach out to advisors if you want more one-on-one assistance. Now I'll move to questions, starting with the chat. The first one I have is, would the owner investments loans for the month be equal to your expected expense? So I think this is referring to in our cash flow. Your owner investment or loans expectation here. This is how much do you expect to either put into the business, that's owner investment, or if I had already applied for a loan and I knew that I was going to be receiving that loan in that month, I need to make sure I'm accounting for that cash. So in this example, it's not equal to the expected expense, because maybe in this example, I was thinking, all right, I've calculated my expenses for this first month of starting this new business. I think it's about $340, but I'm accepting that sometimes things cost more money than than I might intend them to. So I am willing to invest $500 of my own into this business to make sure it can operate for at least a month. And from what you can see here, that I'm showing that my ending cash is growing. So, if you overinvest into your business, there's really no negative impact because as your cash flow grows, you can just take it back out. You can move money kind of freely in and out without tax implications. But as long as you're thinking about it as owner investment. Um, so if you're thinking about it as a loan, it is more complicated. So I'd say, in brief, when we're thinking about investing in our business, especially at startup stage, it's nice to put a little extra cushion in how much we're willing to invest in our business. So next question is, where is the best place to get industry data? So again, gotta plug working with an SBDC advisor because we have licenses to some paid, subscription paid data sources. We use IBIS World, Vertical IQ. They are behind paywalls, but an advisor can share reports about your business. That said, there's plenty of free information available out there through Google. That I'll try a general internet search. Different industries have different data sources available, so it never hurts. But take advantage of the resources that can be provided from an advisor. The register with the in these slides at the end, all of these upcoming webinars are links. So you are welcome to click in from here and it'll take you to the registration page for each of the upcoming talks. Also on the Capital Pathways website, if you go to the Capital Pathways website, there is a section that says upcoming webinars that you can always navigate to check out our upcoming webinars and trainings. So now, the accounting templates also are linked in our presentation on one of the slides when we're in the basic bookkeeping. And then I have another question just to clarify, where do we document owner investments? So owner investments are equity transactions, just like owner draws. Um, I would, if we are using the spreadsheet that I shared here, I would track it at the bottom here. So I don't have an input for our revenue, expenses, owner draws. But an owner investment is essentially a negative owner draws. So they're both hitting the equity section of our balance sheet. This is getting into some nuance again, but what's most important is if you, as an investor, are putting money into your business, it is not revenue. So it should be tracked separately. So if we wanted to, you could, for example, this is what would happen. I could change the wording here. If I were to say negative 100, this would be owner investment. Then what I would see on this actual P&L here would show a negative owner draw. I don't love that. I would prefer to use this sheet as I originally intended, but and then track in my actual to say, hey, I invested $500 in the business in this way. So again, it is a non-operating expense. It would appear on your statement of cash flows and your balance sheet. It does not appear on your income section. So with that, we have 2 minutes left and I don't see any other questions. So um, happy to be wrapping up, not overtime today.
Well, first of all, I would like to thank you, Kara, for your time. You're very, very valuable and insightful presentations as always. Um, and I encourage everyone to look at the upcoming webinars, and you can always look at our website in that section that Kara showed earlier. In upcoming webinars, there's all the Capital Pathways webinars in January, February, March already uploaded. And if you are interested in one-on-one advising support, I did leave the website link in the chat. and my email. So feel free to book um, an intake call for us to be able to help you and connect you with an advisor that can help you with one-on-one support. Um, I encourage people in this call to ask any last minute questions. We can stay one more minute or two. Um, and if in a minute or so we don't receive any questions, I wish everyone very happy holidays and thank you, Kara, again once more for such a wonderful presentation.
Thank you, Lena, and thank you for everyone who came out today.
Let's wait one more minute just in case
Yeah.
there is one more question. And I see some people are raising their hands. If you can include your question in the Q&A, that would be perfect. Um, all right. Well, I don't see anything coming in. So, thank you again, everyone, and have a great rest of your days. Oh, yep. Wonderful. Goodbye, everyone.